Hello and welcome to Pro Trader Strategies market commentary for Friday, August the 30th, heading into a Labor Day weekend. My name's Eric Wilkinson, and you may recognize me as the Wolfman on mainstream media. But what I'm here to do is teach you how to trade some options. Actually, I'm here to teach you how to implement those options, not even just to build them. There's specific rules in and around how to implement those that nobody else is really going to do, especially on mainstream media, as I talked about yesterday with the gentleman talking about buying calls and high implied volatility. So anyway, past performance of any trading system or methodology is not necessarily indicative of future results. That guy should have to put that in his statement every time he's talking. Anyway, let's talk about the economic data across the pond. We've got European CPI, which is Consumer Price Index. Flash estimates coming in line with expectations at 1%. Core CPI, which is stripping out food and energy, coming in at 0.9%, expected to be 1%. Then we move back over here to the United States, because who really cares about Canada right now? We got personal spending. Sorry if I offended any of you Canadians, but your economic data points aren't really going to affect the overall economy at this point. So we got personal spending here in the United States, and it came in at 0.6%, higher than the expected 0.5%. That's not necessarily a bad thing, right? We like to see the consumer spending, because that shows the confidence. We saw that in consumer confidence not too long ago. So the consumer is confident. They are spending more money. One downstroke of that is that the personal income only upticked by 0.1%, expected to be a 0.3%. They did revise last month's number up by 0.1%, but that's not making up for this headline number. One thing to note with this, if we don't have income increasing at the rate that we're spending, it usually means that we are buying things on credit, and that's not always the best thing to have. And then we got core PCE, which is personal consumption expenditures price index, came in at 0.2%, expected to be 0.3. That's a good thing. We're not seeing that price inflation, and you know, that's good, because we're not seeing the wage inflation either. So both of those kind of run hand in hand in a sense. And then we also got Chicago PMI, which is Purchasing Managers Index. Came in at 50.4, expected to be 48.1. Now, something to note here with this PMI number, we get 3 PMIs in a row below 50. That would be contraction. Anything below 50 is contraction, but at 3 in a row signals recession. Well, we got this one back above 50, so we only got 2 in a row, and now we got back above 50. So no real sign of inflation. We were pretty close to that. One could say that we are still on the precipice of that, but that being said, that number moving above is really kind of causing the overall equities in the broader markets to kind of sell off, because maybe we need to throw a tantrum to make sure that the Fed stays on path with lowering interest rates. And then we got consumer sentiment out of the University of Michigan coming in at 89.8, expected to be 92.5. Inflation expectations out of University of Michigan coming in at 2.7. So all of those economic data points don't seem so bad, especially when we look just at the raw data versus seeing what everybody is saying online. All right, so let's move over to the charts here. We've got crude oil off by about $1.60. Again, back below that purple line that we have there, but migrating back to the point of control. I've talked about this. I'd like to see oil at these levels. I don't want to see a massive spike here, especially when the economy is kind of in flux as to if we can continue to expand, or that higher cost of crude oil going into the distillate process for manufacturing or for the consumer. We don't want to see necessarily. All right. Sorry about that. We'll get back to Wesley not too long. He is one of my people I like to talk about with the markets. So anyway, let's move on and then talk about gold futures. They're coming off just a little bit today, but staying above that area of 150 or 1533, and that is going to be that line in the sand. We are still continuing to see higher highs and higher lows. We go over to the bonds. They're off a little bit today as the economic data is showing that the economy isn't doing too bad. That being said, bonds start to come off on that likelihood of a Fed hike starting to dwindle just ever so slightly. And then the VIX is probably the only thing that is in the green today. Everybody's probably having a rough day with the equities trying to sell off here. We do have the Dow Jones Industrial Average up 14, almost 15 points on the day, but just feeling like a very negative day. As the day goes on, we're seeing that weakness continue to filter into the overall markets. NASDAQ down about 35 points today, but we are still in that range. We haven't gone anywhere. I've talked about this. We are sandwiched between the 78 Fibonacci extension and the 61 Fibonacci, but right in between that sandwich, we have the white Oreo of the cookie, and we are heading back down to the meat of it. Again, similar situation seeing here in the E-mini S&Ps, down 3.5 points on the day. Not a whole lot to see here. We haven't broken out of that range either for the E-mini S&Ps, which is the 23 and the 38. So again, we are moving around but haven't really gone anywhere. You can see overnight inventory in the E-mini S&Ps got very long because this is a 30-minute candle. Each of these candles is 30 minutes. The blue section is the entire day. Gray overnight day session is the darker. So what we have here is overnight inventory got very long. Those are the weaker hands heading into the day session. Now, when we get that flush out, which is what we've seen, we've gotten the weak hands out of the picture. Now it is going to be a product of the rest of the day heading on. The last weekend in the Hamptons. Remember, I've been talking about Fridays are the rush to the Hamptons. This is going to be a massive rush to the Hamptons, so I really don't expect the markets to really break out of the range that we've already created. I don't think that there's enough economic data to drive in either direction, and at this point, I think the market is going to settle down. We may get some spikes here and there on the lack of liquidity in the markets as people are starting to leave early today. So, keep that in mind as well. But having said that, I'm not adding anything to my position at this point. I'm going to let everything kind of ride out until we get really a discernible direction. If we break out of this range, is going to be really the catalyst for me to start getting into some more strategies. At this point, we don't have a whole lot out there that has high implied volatility to sell premium around a idea where we are going to maybe trade sideways and lose some of that volatility. We've kind of already gone through that whole cycle. Now it's like, all right, well, it's time to start thinking about debit spreads, the iron butterfly, which is what I just did a webinar on yesterday. It's great for this kind of environment. If you expect the market to have a big move, we break out of this range that we've been seeing in the E-mini S&Ps, the Dow Jones, and whatnot. So this iron butterfly would be great for a situation like this, or maybe even the iron condor if you expect us to break out of those two Fibonacci areas. I don't think that there's anything really market moving enough to do that, especially today. We're getting a little bit of a top here, and I believe we're going to kind of start migrating back down. We need some catalyst to really get this market moving. And that's about all I've got for you guys. I hope everybody has a great extended weekend. I will see you again on Tuesday doing the market commentary, but in the meantime, have fun with your family, and I'll see you then. If you can't take that, take it easy.